Friends, I, Captain Vivek Jain, welcome you all to my 19th episode. In our earlier discussions so far, we have learned the fundamental analysis of a company by study of various available financial statements such as balance sheet, profit and loss account, financial ratios. We have also learned few formula-based guidelines for reckoning the intrinsic value of the equity share. Additionally, in our previous episode, we have discussed and understood several other factors extracted from the financial statements and ratios, which also should be considered along with the intrinsic value before making the decision of investing in the equity shares of any company. Friends, today we shall discuss and demonstrate few companies chosen at random with actual parameters, along with their prevailing intrinsic values. So friends, I have my Excel file over here. Intrinsic value will be given in the end of the sheet. We will discuss the miscellaneous other parameters, which along with the intrinsic value reckoned from the two formulas will give us a good guideline on whether a share is below its intrinsic value, below and the market value is underpriced, or is it fully priced or overpriced. The first company that I've chosen is Dr. Reddy Labs. It's a prominent company in pharmaceuticals. I have shown the working of the past 4 years, 5 years, 16, 17, 18, March 19 and March 20 ending. And additionally, I have also shown the half yearly ending, which has been declared in 2 quarters, end of June and end of September, and I have combined them together as a half yearly of September 20. As you can see here, Nifty closed at a low of 7,610 on 23rd March 2020, and then it stabilized and it closed at 9,384 on 13th May 2020. And by that time, the various reports of companies were also released. So I have arbitrarily chosen as 13th May 2020 to be the dates when I will be reckoning the intrinsic value, which I will show you at the end. Dr. Reddy closed at a low of 2,624 on 19th March, and it closed on 13th May at 3,780. These two figures we will be discussing in the end again when we are discussing the intrinsic value. For the time being, friends, let's have a look at the parameters. You see the sales revenue of the past 5 ending years from March 16 to March 20 is ranging between 15,568 to 17,000 with a very good market capitalization of more than 50,000 crores. And this sales revenue is indicating a good growth of Dr. Reddy. And for half yearly September ending, when the pace really picked up, it has shown 9,337, which if doubled, which it should be normally, it may cross 18,700 crores March 21 ending. The market capitalization I have just told you is very good. Current ratio has to be more than 1.25 as per the experts, which we had discussed earlier also. And it has got a very good handsome current ratio ranging from 2.1 to 2.5. Debt equity ratio is also very, very acceptable from 0.27 to 0.11. Practically debt free, you can call it. The net profit has been for March 20 ending 1970, which has been increasing for past 3 years. Before that, it was more than that. For various reasons, it has decreased over the years, and then now it is gathering pace. Net profit for September ending 6 monthly, that is half yearly, is very, very good, 1,351, which if annualized may turn out to be anywhere near 2,700. Dr. Reddy has given good dividend over the years. The dividend payout ratio has been quite substantial. between 20% to 33% is the norms, and it has been more or less within that range. Earning per share has also in the past 3 years increased between 57 to 122. And the 6 monthly earning per share is very handsome, 82 rupees, which if annualized, Dr. Reddy can probably give and post an EPS for March 21 ending anywhere between 150 to 160. Price earning ratio also is about 25 all along. In between, it has gone up to 36. Book value has been increasing every year from 737, it's up to 939. That is shareholders' reserves funds included in the equity capital. Price book value ratio is also very, very good, ranging between 2.75 to 3.4 or 3.5, and right now it is 3.32. Price to book value ratio is also something which you will have to use your own judgment and discretion. But basically, if it is between 2 to 5, especially for a pharmaceutical company, it is considered to be very much acceptable. Equity to sales ratio. This is a very important factor because the ratio of sales as compared to the equity of a company should be as much more as possible, because it is only then that with any kind of a net profit, the earning per share will be substantial and the company will be able to serve that equity. Company will be able to declare good dividend, and as an investor, we can expect good capital appreciation. And in case of Dr. Reddy, it is very, very handsome, ranging from 188 to 211. The experts, they say it should be minimum 10, if not more. Not less than 10, then it will be very difficult for the company to serve because the equity capital. Because even if it is 10 and the net profit is about 10%, then the equity, the earnings, the net profit will be equal to the equity. The earning per share will be, if the face value is 10 rupees, it should be 10 rupees. And if it is face value is 1 rupee, the earning per share will be 1 rupee, which is considered to be good. But in case of Dr. Reddy, it is very high, 211. It's the latest March 20, 31st March 20 ending. So I think this really shows the standard and the quality of the company. Having known and seen and understood these parameters, which you will probably get used to once and familiarized once you keep checking it for various other companies, we come to the intrinsic value. I've chosen two very simple formulas. In my earlier episode of intrinsic value, I had given 3 formulas, but out of that, for simplicity's sake, I have taken 2. The first formula is the most simple one. Intrinsic value is price earning ratio into EPS. For a pharmaceutical company, we can consider a price earning ratio of 30 to be a normal one, as you will be able to see in most of the pharmaceutical company, it is somewhere, it is maybe below 30, but most of the pharmaceutical company will have well above 30. An average would be around 30, 32, 33. So with a price earning ratio of 30, the latest earning per share you have seen is 122 for 31st March 2020 ending. The intrinsic value works out to 3,660. Whereas if you consider the formulae of Benjamin Graham, the guru of Warren Buffett, so to speak, this formula is earning per share multiplied by 8.5 plus 2G. G is the projected annual growth rate. In case of Dr. Reddy, we have taken a very good figure of 12%. 12 into 2 is 24. 24 plus 8.5 is 32.5, which multiplied by EPS of 122 works out to 3965. So from these two formulas, we are getting a range of intrinsic value between 3660 and 3965. And now you can see this particular rate of closure of Dr. Reddy as on the stabilized date of 13th May 2020. It is showing at 3780. So I would say that 3780 price of Dr. Reddy at that time was absolutely correct and fully priced. near about the intrinsic value. If anyone who would like to invest in Dr. Reddy could have very well invested. Between March and May, definitely it was below the intrinsic value, and around 13th May, it was at the intrinsic value. For your information, today it is November 2020. You must be well aware that Dr. Reddy is nearly 5,000 rupees. It has given an appreciation of in less than 6 months of about 1,300 rupees, which is about 30%, quite substantial. And if you also take into account the annualized earning per share projected for March 21, which is about 160 rupees, 160 multiplied by even 30 gives 4,880. In other words, the present value of Dr. Reddy is somewhere near intrinsic value, if I may say so. We now come to the second company. This is a prominent information technology company, Infosys Limited. You can see Infosys Limited closed at a low of 526, and then we will discuss this figure later on. And the index we have already discussed earlier. For past 5 closing years from between 2016 to 2020, Infosys sales revenue has been ranging between 54,000 crores to 79,000 crores, which is showing a very, very good growth. Half yearly, September 20 sales is 48,000. And in case of Infosys, as we have seen in the past 5 years with experience, you can very well double it. It means you can very well expect a turnover of nearly 96,000 crore for 31st March 2021 ending. Market capitalization is very handsome. Current ratio is extremely good, and debt equity ratio, needless to say, in case of Infosys, it had always been, and it is still absolutely zero. They do not believe in taking any kind of debt. Net profit also has been increasing quite substantially between 12,693 to 15,543, which itself gives you a very good picture of the company. And the 6 monthly net profit is 9,000, which if annualized becomes nearly 18,000. Dividend per share also is quite handsome. You can see after bonus 1:1 given in 2019 ending, the dividend has been still quite a lot, which doubled becomes almost at par with the earlier dividends. Dividend payout ratio is, in case of IT companies, is always high, and the norms here is about 50% or so, which is very good in case of Infosys. Earning per share, you can see, also has been increasing quite well. After bonus 1:1, it has become 33 and then 36. And for half yearly ending is 21.4, which if annualized becomes 42.8, which is the expected earning per share for 21 March ending. Price earning ratio, you can very well see for Infosys nearly 18 to 20. Book value also has been quite increasing well. Price book value ratio is also quite acceptable. Between 3 to 5 it is. Highest it was 5, now it is 4.38. Equity to sales ratio. This is also very, very good, ranging between 51 to 37. This figure became less because of the bonus of 1:1. IV, that is intrinsic value, as per a simple formula, with the earning per share of 36 rupees multiplied by PE of 25, which is considered to be an average PE for IT companies, it comes to 909. And by Benjamin Graham's formula, with the growth taken at 8% per annum, it comes to 890, a range around 900 rupees. And you can very well see Infosys closed on 13th May at 694. So it was well below the intrinsic value, absolutely shrieking to buy. And if anyone would have bought it at that price, even at less than 694, it was even better. But if you purchase it at 694 also, 206, 207 rupees, nearly again 30% profit in a matter of less than 6 months. And with the earning per share becoming 42 annualized expected in March 21, 42 multiplied by 25 would give you a figure of 1,050. And that is the figure, friends, you will be able to check today in November 2020, Infosys presently is commanding that price. So it also, I would say, is at an intrinsic value, and anyone who would like to invest in Infosys, and if is convinced with the parameters, then at any kind of a dip in the trading days in the next coming week, one can go for Infosys without any problems, with the eyes shut closed, so to speak, and it will give you a good profit, capital appreciation, and dividend. And it is a share which should be kept in a portfolio for long term on a definite manner. We come to now the third one, which is a fast moving consumer good company, a prominent one, Britannia Industries. As you can see, Britannia Industries, I'm showing you the figures of March 16 to March 20. The sales revenue has been quite reasonably and quite well, appreciating between 8,400 to 11,600. In between, for period ending March 19, 2 rupee face value share of Britannia was split into 1 rupee. So the number of shares increased in the hands of the investors. The face value reduced by half. Market capitalization also is quite good. Current ratio is also more than 1.25, more than 1.25, ranging between 1.5 to 2, which is very good for a fast moving consumer company. Debt equity ratio had always been all along zero. For the period March 20 ending, it had to take a little bit of a debt, and probably in March 21, we might see it zero again. Net profit ranging from 825 to 1403 speaks for itself. And this is the ladder which an investor must see very, very closely, so that the standard, the quality of the company is picture clear. Absolutely. The perspective is very prominently seen and visible. Net profit for September ending, you see, with a sales revenue of 6,400, which if annualized becomes nearly 12,800 or 12,900, and the net profit is very handsome. This, if annualized, becomes nearly 1850 to 1900 crores. So we can expect a very good net profit figure in March 21 ending. Dividend also is good from 20 to 35%. Dividend payout ratio is very handsome, ranging from 32 to 28%. Earning per share, you can see 62, 70, 79. After splitting, it becomes 47, which if you pre-split, you can call it 94. 62 and 41 is the half yearly, which if annualized becomes 82. This 82 figure is something that the growth of the company has been very, very good, very, very handsome. Price earning ratio, you can see, ranging from 40 to 44%. Book value also has been quite good all along, with the 1 rupee share, the book value being 178 is very handsome book value. Price to book value ratio, in case of a fast moving consumer good company, it is always high, sometimes more than 10. Here it is because the company is very prominent, and the price to book value ratio is high. There are many other FMCG companies like Hindustan Unilever and Dabur. There also you will find that the price book value ratio is rather high. This you'll have to accept it. That is why you have to use your discretion for a specific industry, and should be reasonably acceptable to you at the normal level of that industry. Equity to sales ratio is extremely good in case of Britannia. Not 100, not 200, not 300, well near 500, ranging between 350 to 483. And this is another reason that the earning per share is always handsome, and Britannia is not only able to give very good dividends over the years, even the capital appreciation commanded in the market is very good. Now we see the intrinsic value by simple formulae, where I have taken a price earning of 40, which is considered to be normal for a good FMCG company, and that multiplied by the latest earning per share of 62 works out to nearly 2,800 rupees. And if we take the Benjamin Graham's formula with the growth pegged at 15%, which is quite handsome for any company for that matter, it is coming to 2695. From 2695 to 2800, As we see, you can see that Britannia closed on 13th of May at 3,080 rupees. So it is slightly above the intrinsic value at that particular time, and when the market stabilized. So one could have possibly waited for a few more days at that time in case any dip comes, could have purchased it. Today, in November 2020, as you can see that the annualized EPS becoming 80, which if multiplied by 40, it comes to around 3,200. And Britannia right now is also priced around 3,400 rupees. So about 200 rupees more than the intrinsic value. So it's just that if investors are interested in this company and they are convinced with these parameters, they can very well wait that in the month of November, once the market peaks out, it may take a dip, and with those dips, you might get Britannia near the intrinsic value and one can grab it. Definitely, because Britannia is a share which can be kept for long term without any doubt. Is absolutely with no sleepless nights. Absolutely, you can sleep peacefully, and it will not only give good dividends, it will really give you capital appreciation. Uh, Absolutely, over the years, it should be really acceptable to you very much. And after a long-term period, you will be possibly thanking yourself to have purchased this share. Friends, after this presentation, please do visit available websites, AGM reports, and other sources of various companies that you may be interested in, enabling you to be more and more familiar with the actual financial parameters, reckoning of intrinsic values, comparing them with the prevailing market price, and that will make you understand the relationship between them so much more clearly. Friends, in our next discussion, we shall undertake the discussion on the history of stock market index, the indices, Sensex and Nifty, the two most popular ones. We will try and understand their formation, their purpose, and significance. Till then, let me remind you to ensure subscribe to this channel in case you have not done so as yet. And that will provide you with all earlier and future episodes easily on your screen. Do post your comments and queries, if any, to which I shall indeed reply. Friends, see you again soon. Have a nice day and happy investing.